Introduction. Welcome to our deep dive into the world of accounting, a cornerstone of economic and business activities across the globe. Today we'll explore the myriad roles that accounting plays in the modern financial landscape, from basic principles to the strategic involvement of accountants in business decision-making. Join us as we unfold the layers of this dynamic field, essential for professionals, students, and anyone interested in understanding the pulse of financial systems. Basic accounting principles. Accounting rests on a foundation of several core principles that ensure the reliability and consistency of financial reporting. These principles are like the rules of the game for accounting, helping businesses report their financial information clearly and consistently. Let's break down 3 key principles that every business uses to keep their finances in check. First principle, accrual basis of accounting. First, we have the accrual basis of accounting. This might sound complex, but it's really just about timing. Instead of recording money only when it changes hands, this method records revenues and expenses when they actually happen. For example, if you sell a product in March but don't get paid until April, you still record the sale in March. This helps companies get a real-time snapshot of their financial health, showing how much they're earning and spending during a specific period, regardless of when the cash is received or paid. Second principle, consistency. Next up is the consistency principle. This principle is all about keeping things the same from one year to the next. Why does this matter? Consistency makes it easier to compare a company's financial reports year after year. If a company changes the way it records sales or expenses, it's harder to tell if a change in their profits is due to better sales or just a new accounting method. Keeping the same methods ensures that any changes in the numbers are due to actual changes in the business, not just accounting tweaks. Third principle, prudence. Finally, we have the prudence concept. This is about being cautious in how financial information is reported. It tells accountants not to be too optimistic about how well the company is doing. This means they should be careful not to overstate how much money the company has made or underestimate the expenses. The idea is to avoid giving a falsely positive picture of the company's finances. It's better to be a bit conservative so that no one is misled by overly optimistic financial reports. Ethical considerations in accounting. Ethics in accounting are non-negotiable. Accountants must adhere to strict ethical guidelines to maintain trust and transparency in financial reporting. This includes integrity, objectivity, professional competence, and confidentiality. Ethical accountants protect stakeholders from financial misstatement and fraud, reinforcing the trust that is pivotal in financial markets. The accounting cycle. This cycle is a fundamental concept for businesses to manage their financial information effectively. It's like a roadmap that accountants follow to keep track of every dollar that comes in and goes out of the business. Let's walk through each step to see how it works. Step 1. Identifying and recording transactions. The first step in the accounting cycle is identifying and recording transactions. Every time a business makes a transaction, whether it's selling products, purchasing supplies, or paying salaries, it needs to be recorded. These transactions are first noted in journals, which are like detailed diaries of all financial activities. This step ensures that every financial move is documented right from the start. Step 2. Posting to the ledger. Once transactions are recorded in the journals, the next step is to post these transactions to ledger accounts. Think of ledgers as individual accounts that categorize each transaction. For example, there might be separate ledgers for sales, supplies, and wages. Posting is like sorting all these transactions into their respective buckets to keep things organized. Step 3. Preparing the trial balance. After all transactions have been posted to the ledger accounts, an initial trial balance is prepared. This involves listing all the accounts and their balances at a specific point in time. The trial balance helps ensure that the total debits equal the total credits, providing a check and balance that entries are made correctly. Step 4. Making adjustments. Next, adjustments are needed. Not all transactions fit neatly into the accounting period, so adjustments for accruals and deferrals are made. Accruals involve expenses that have been incurred but not yet paid, like utilities, while deferrals might be prepayments that need to be allocated over time. Adjusting entries ensure that the financial records reflect the true financial status of the company at the end of the accounting period. Step 5. Adjusted trial balance. Once all adjustments are made, an adjusted trial balance is prepared. This step revises the initial trial balance to reflect all the adjustments. It's like double-checking that all financial activities are accurately represented before final reports are made. Step 6. Financial statements. With the adjusted trial balance complete, the next step is to prepare the financial statements. These are the reports like the income statement, balance sheet, and cash flow statement that summarize the company's financial performance and health. They provide a clear picture of the business's financial results over the accounting period. Step 7. Closing the books. The final step in the accounting cycle is closing the books. This involves closing temporary accounts like revenues and expenses for the period and starting fresh for the new period. It's akin to resetting the counters to zero for the next game or period. The accounting cycle is a crucial process that helps businesses keep their financial records in order, ensuring accuracy and readiness for making informed decisions. It's a systematic approach to handling and reviewing financial information that supports transparency and accountability. Technology's impact on accounting. Modern accounting is deeply intertwined with technology. Software solutions like QuickBooks for small businesses or SAP and Oracle for larger enterprises automate many accounting tasks, enhance accuracy, and provide real-time financial data. This shift not only increases efficiency, but also allows accountants to focus more on strategic analysis rather than routine data entry. Understanding financial statements. Financial statements are the culmination of the accounting process. The income statement reveals the profitability of a company over a specific period, while the balance sheet provides a snapshot of its assets, liabilities, and equity at a point in time. The cash flow statement tracks the inflow and outflow of cash, crucial for assessing the liquidity of the business. Each of these documents plays a vital role in stakeholders' decision-making processes. Strategic role of accountants. Accountants are not just number crunchers, they are strategic advisors. By analyzing financial data, they help forecast future trends, aid in budget preparation, and assist in resource allocation. Their insights are crucial for formulating business strategies, managing risk, and ensuring operational efficiency. International accounting standards. In an increasingly globalized business environment, understanding the International Financial Reporting Standards, IFRS, and the Generally Accepted Accounting Principles, GAAP, is essential. These standards ensure consistency and transparency in financial reporting across international borders, facilitating global trade and investment. Career opportunities in accounting. The field of accounting offers a diverse range of career opportunities, from traditional roles in public and corporate accounting to exciting niches in forensic accounting, which involves investigating financial crimes, and environmental accounting, focusing on integrating environmental and economic information. Each specialty offers unique challenges and opportunities to make a significant impact. Emerging trends in accounting. As we look to the future, several trends are shaping the accounting profession. Sustainability accounting is gaining traction, emphasizing the importance of environmental costs in financial decisions. Artificial intelligence is automating routine tasks, allowing accountants to focus on more strategic activities. Additionally, integrated reporting is emerging, which combines financial and non-financial data to give a holistic view of a company's performance and its impact on the environment and society. Conclusion. Accounting is indeed much more than numbers and balance sheets. It's a dynamic field that adapts to changes in business practices, technology, and regulatory requirements. By ensuring transparency, fostering trust, and aiding strategic decision-making, accountants play a crucial role in guiding companies towards sustainable success. Whether you're a student, a professional, or simply a curious mind, understanding the depth and breadth of accounting will provide you with valuable insights into the financial workings of the world around us.